Welcome back, ladies and gentlemen, to another video. Sorry if you're hearing somebody playing like the Beach Boys or whatever, some garbage over there. But I live in a apartment complex basically, and we got neighbors, ladies and gentlemen. But today we got mad money. So why am I putting mad money on the screen? And that is because today Jim Cramer, the Mad Money Man himself, is going to tell us who actually moves the markets. Okay, so there's been a lot of this retail frenzy in the media, but I want you guys to see a clip towards the end of this video. But first, we need to talk about who is Jim Cramer. Okay, so he used to be a hedge fund manager, and now he manages a show called Mad Money, where they give questionable stock tips. But I think it's better for me to show you, because I can show you better than I could tell you. Here's Mad Money.
Mad Money Lightning Round is brought to you by TD Ameritrade, where smart investors get smarter.
It is time! It's over the lightning round! What is that? That's what all the time when I'm just saying by myself. And then the lightning round is over. Are you ready? Ski, dang! Over the lightning round coming from. Why don't we start with Lou in Florida? Lou!
Booyah, Jimmy.
They're not Lou. They're not booing. They're Louing. What's up?
Well, you know what? I bought some DDD a while ago, and it's come down.
Yeah, but you know what? They actually are making a comeback. I got to get them on the show. I mean, it got a little overheated. Became one of those stocks, you know, it was like a meme stock for a while. You know, when I realized I had a meme, whatever. But you know what? I want you to stick with it down here. I believe in 3D. I think you're going to do okay.
Okay, let me cut in here. So first of all, what the f did he just say? Secondly, do you feel any smarter? And I'm not saying that, you know, I think any less of you if you just got a lot of educational value out of that, but don't talk to me. Anyways, moving on. Mad Money is basically a show that tells you whether or not to buy or sell stocks. So I'm starting a new series. So I'm going to go ahead and spare you the rest of the show there, and I'm going to show you guys what he said to buy and what he said to sell. So basically what I did is I went into Webull and I went into Paper Trader. I think it's optionspapertrader.com or something like that. I'm going to show it on the screen right now. Feel free to grab those free stocks in the description from Webull if you want to do your own paper trading or you want 2 free stocks. They're usually valued up to about $25 for the 2 of them. So anyways, this is what he sold us to buy, okay? So I'm going to go ahead and we're starting at $1 million in the Webull account. I'm going to buy $3,000 worth of each stock that he says to buy on Mad Money. I'm not sure how often I'm going to do this. I'm basically just going to do it whenever I feel the inspiration to follow Jim Cramer and subject myself to Mad Money. This is what he told to sell. Annaly Capital is actually kind of a garbage stock. They have a really high payout ratio. I'm not sure about Revance Therapy, but that's not the only thing that we're here to talk about today. But basically, this is how the game's going to work, okay? I'm going to buy everything that he tells us to buy in one portfolio. I'm going to buy everything that he tells us to sell in another portfolio. Then I'm going to compare that to my portfolio, and I'm going to compare it to the index. So it should be a fun game. So traders, 95% of them, and studies vary on this, lose money. So we're going to get into why. So fees, bad timing, selling the bottom, having no plan or a bad plan. So essentially, there's a lot of frenzy out there, right? And traders think that they're going to make money. Well, when you're in a green market, everybody's making money. It doesn't matter when you're getting in, it doesn't matter when you're getting out, it doesn't matter what you're doing. As long as the entire market is going up, you're making money, okay? So as I always say on the channel, the best holding period for a company that's growing its earnings is 10 years. If you go look at a company that's growing its earnings over the course of 10 years, the stock price is up and to the right. So anyways, who really moves the markets? It's the hedge funds and the mega rich, the Federal Reserve, and we already said 95% of traders lose money. So these are the market manipulators right here, okay? The hedge funds themselves, and Jim Cramer is about to tell us this in very graphic, gory detail in an interview that was leaked. But I want to show you guys this interview because a lot of people, they believe analysts, they believe that companies don't communicate with each other, do price fixing. They believe that CNBC is a credible source of news. They believe all of these hit pieces that come out on financial news media. Okay, they think that the Federal Reserve is printing money for the poor instead of printing money that is supposed to be spent at businesses so that they can prop up the price of assets for the rich. Okay, and another market manipulator in here is bullish and bearish headlines. Okay, they don't even have to be true, but I'm going to close out the video, and this is a precursor to tomorrow's video, which will be a Market Monday, basically. I don't want to steal Market Mondays because that's already a show, but I just want to show you guys what's going on in the markets. But anyways, let's tap in with Jim Cramer, and I'll see you guys in the next video. But definitely make sure you guys watch this all the way through because it's really eye-opening. Go ahead and speed it up if you need to.
Welcome to Wall Street Confidential. I'm Aaron Task, joined again by Jim Cramer. Jim, welcome.
Good to see you.
Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
right?
And it is a very quick way to make money and very satisfying.
Okay.
Well, by the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
Well, on a related note, there's so many more hedge funds today than when you were managing your hedge fund.
Right.
Do you think that does that exacerbate the moves, or does it make it tougher?
Well, you know, the hedge funds are positioned long short, okay, not just long like mutual funds. So it's really vital these next 6 days because of your payday. You've really got to control the market. You can't let it lift. When you get a research in motion, it's really important to use a lot of your firepower to knock that down because it's the fulcrum of the market today. So I mean, let's say I were short. What I would do is I would hit a lot of guys with RIM. Now, you can't foment. That's a violation of
Foment?
Yeah, you can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. So, that's the only sense that I would say this is illegal. But a hedge fund that's not up a lot really has to do a lot now to save itself. So, this is different from what I was talking about at the beginning where I would be buying the Qs and stuff. Right. This is actually just blatantly illegal. But when you have 6 days and your company may be in doubt because you're down, I think it's really important to foment, if I were one of these guys, foment an impression that research in motion isn't any good because research in motion is the key today. So, you know, you would hit this guy and that guy, and when you would see an offering, when you see a guy who's bidding, you'd wipe out that guy very quickly. And what I used to do was called, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million, Annie, to knock RIM down. But it would be fabulous because it would beleaguer all the moron longs who are also keying on research in motion. So we're seeing that. That's, you know, again, when your company's in a survival mode, it's really important to defeat research in motion and get the Pisanis of the world and the people talking about it as if there's something wrong with RIM. Then you would call the journal and you get the bozo reporter on research in motion and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today. And if you're not doing it, maybe you shouldn't be in the game.
Okay. Another stock that a lot of people are focused on right now seems to be Apple.
Yeah, Apple's very important to spread the rumor that that both Verizon and ATT have decided they don't like the phone. Right. That's a very easy one to do because it's also you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story. and you can claim that it's credible because you spoke to someone at Apple, because Apple isn't and it doesn't.
Right, they're not going to comment. They're not going to say.
So it's really an ideal short. And I would, again, if I were short Apple, I would be working very hard today to get that. And the way you would do that is you pick up the phone, and you call 6 trading desk, and you say, listen, I just got off the phone with my contact at Verizon, and he has already said, listen, we're a Lucky G house. We're a Samsung house. We're a Motorola house. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music. And, I think that's a very effective way to keep a stock down.
Right.
I might also, by the way, because the stock at 84, 85, with a little bit of capital, you go buy some January 80 puts that makes it look like there's going to be something going on. So maybe you give Morgan an order to buy 1,000 Jan 80 puts. Then you go position limit with you use a firm that doesn't know what the heck it's doing. Maybe you go to UBS for puts. And you just kind of create an image that there's going to be news next week, and that's going to frighten everybody.
Right.
Then they all go out and say large put buyer UBS. And then they call Pisani again. You have to use those guys and say, listen, I see a big buyer of puts, and I'm told that it's SAC. You would do that too. And these are all what's really going on under the market that you don't see.
Right, and nobody else talks about it except
but
you.
What's important when you're in that hedge fund mode is to not do anything remotely truthful. Because the truth is so against your view that it's important to create a new truth, to develop a fiction. And the fiction is developed by almost anybody who's down like 2% to up 6% here. You can't take any chances. You can't have the market up any more than it is if you're up 6. Because starting Jan 2, you'll have all your money come out. So what would you do if you're in that situation and you feel like you're desperate, is that you would do these actions?
So you're talking about the mechanics of the market.
Well, mechanics are much more important than the fundamentals.
Oh, okay, well, but in terms of the fundamentals, you've been writing about how you
Who cares
think
about the fundamentals? Research in Motion just blew out the quarter.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Now, look, over maybe 2 weeks from now, the buyers will come to their senses and realize that everything that they heard was a lie. But then again, Fannie Mae lied about their earnings for $6 billion. So,
right, and Bristol Myers lied.
It's just fiction and fiction and fiction. And I think it's important for people to recognize that the way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game. And it can be played. You can pay for a % or two.
Right, and then do you get long before Macworld and the expectation that the iPhone is going to be
down.
good? Right, and then you go back, flip to the long side.
You certainly got to use the other side.
Interesting.
And there's a case where I would say the January 80 puts can be justified, because after I've knocked the stock down to 80, I can buy a lot of common. And then you play it right into Macworld, where they'll probably introduce the phone and Verizon's going to take it.
Okay. Well, maybe the fundamentals don't matter, but let's talk about the Fed.
Remember, what Wall Street Confidential is not giving you the party line. Oh, here's the party line, by the way. I spoke to Apple on the phone. I hear the phones are good, and Verizon might take it. And as a matter of fact, the Research in Motion sellers, I don't think they know what they're talking about.
But you've been writing about the cell phone market. You think is you don't want to be involved in that.
The problem with the cell phone market, frankly, is that these guys are all killing each other. Someone has to take a dive. Motorola and Nokia have to get in a room and just fix price. They've been reluctant to do that because of the various justice departments and because
it's illegal, right? Yeah.
Well, that hasn't stopped a lot of other companies.
This is true.
This seems to be a case where they seem to be directly worried about the authorities. It's almost as if they have a lawyer that matters, unlike, say, the Bristol Myers lawyers. And, what eventually happens is the shareholders demand that you get phony lawyers and you sit in the room. And it'll happen soon.
Real quick, the Fed, the numbers out today weaker than expected.
Oh, so what? The Fed has obviously got to cut. But, again, you call the various guys who cover the bonds and you say, ignore the bond action. What's really happened is the Fed is very frightened about, and then you gin up the number that they're really frightened about. The Fed is actually desperate to try to figure out, how quickly they have to cut without looking like dopes that they raised.
Right, because they've been talking about they're worried about inflation all this last few months.
You don't want to raise in May and then cut in January. You look like Mexico, for heaven's sake. I mean, this is like a distinguished group of people who went to really good schools.
Right, these are smart guys. Absolutely.
Yeah, they don't want to look like dopes.
But when we were talking earlier in the week, you said you think it would be some sort of crisis, possibly Ford being a trigger.
Well, Ford went and did all that, they pledged all this investment banking to all these guys, so now that they're very reluctant to say negative things, it makes it much tougher for the Ford story to play out. I mean, the amount of business that Ford has to do. Ford might be the big client of 2007. So if I were in the corporate finance room, I would say, listen to the research guy. I said, listen, I spoke with Mullally. I actually have the inside. The plan works. So then you're the research guy and you say, oh, man, what do I do? It's bonus time. I'm not going to be a total idiot. Spitzer's going to Albany. Let's get back in the game.
Right.
I think that's important.
Is it possible? Because a year ago at this time, a lot of people were saying GM's about to go bankrupt, and of course the stock's up 50-some-odd%.
Well,
could Ford be that stock?
They're GM. No, but GM. The difference between Ford and GM was that GM's balance sheet was never really. It turned out wasn't that bad. Ford's balance sheet's pathetic, and you know that because they were willing to screw over the common for the bonds.
Right.
That's kind of if it weren't Ford, if this were Qualcomm. We'd be saying Qualcomm is desperate, But no, it's Ford.
But it's Ford. It's an American icon.
Yeah, I
and
drove a Ford. I owned a Ford once.
And this is our country. Well,
Yeah,
this
right.
has been Jim Cramer. For Wall Street
Again,
Confidential.
what I'm trying to go for in the Wall Street Confidential, and I'm not saying you're sending me. I have to talk about what it's like at my hedge fund, okay? And what other hedge funds do, because the difference is that if this is an intraday show, and you need to know what I know is going on. Now, we step back. Research in Motion was a real blowout quarter. It was a really good quarter, and I was quite surprised how strong the margins were. It looks like the other guys have really dropped out. It's a terrific story. Should it be up 6? Yeah, I think so. But, look where we are. It's Friday. You got 5 more days to make your quarter.
Right.
Can you really risk having RIM up this much? I don't think you can.
Okay, and they're not. And if I'm correct, you're off next week.
Yes, I am.
Okay, and I am as well. Right. So we'll be back in 2007.
I'm hoping that we finish the year at 1260 because that's at 12,460 because that's what I said at the beginning of the year was. Now, yesterday we came in and we were 20 points away from what I predicted. I want to nail it.
Do you have a forecast for 2007?
Yeah, but I'm not.
It's
over a series of 5 days, so people have to go to realmoney.com.
Check it out on realmoney.com. And Jim, thanks very much for being here. I'm Aaron Task. Stay tuned for more of TheStreet.com TV.
So one question remains with all this. How do I get around this? How do I not become a victim of this? Well, the only way is to do fundamental analysis, which is what we're going to do in the next video. So fundamental analysis, looking at what the actual company is doing, looking at what the actual underlying business is doing, what the dividends they're paying, the actual return on investment, which is the cash that they return to you or reinvest into the business and get a return on that cash. That is what you have to look at. So all this trading, trying to trade news, trying to trade based on hype, that's not going to work for you because it's manufactured. Anyways, I'll see you guys in the next video.